with senior economist Jose Torres with Interactive Brokers. Hi, Jose. How are you?
Hi, Mary. Great to see you. Great to be here again here on our new weekly Sense of Securities podcast coverage. It's going to be great.
Yes, indeed. Okay, so what we're going to talk about today is yesterday's Fed rate cut and everything about it. So just fill us in. What's going on?
Yeah, so we got a 25 basis point reduction. There was one dissenter, newly appointed Governor Stephen Moran. Yeah, so we got a 25 basis point reduction. There was one dissenter, newly appointed Governor Stephen Moran, which, by the way, we had a podcast here at Interactive Brokers with him last year before he was appointed by the Trump administration as chief economist. We invite you all to go into the podcast archives and go check out that podcast with Stephen Moran. Also joining us was Nurel Rubini, also known as Dr. Doom, and of course, chief strategist Steve Sosnick. That fellow, Stephen Moran, new governor, he was more in favor of a 50 basis point reduction. President Trump wants a lot lower interest rates. There's theories roaming around that President Trump installed Chair Myron, who was formerly chair of the Council of Economic Advisors, now at the Federal Reserve. He took unpaid leave from the Council of Economic Advisors to serve as in the Fed rather. He was the only dissenter. He preferred a 50 basis point cut. But what was odd is that Governors Waller and Bowman in July, they dissented in favor of a 25 basis point reduction. I thought that they were going to dissent this time as well, because I thought if they wanted to cut in July and they want to cut now, then why not do a 50 to catch up from the July meeting, which didn't feature a cut. So it showed a lot of unity at the Fed, considering that all 11 voting members were fine cutting by 25 basis points. Chair Powell mentioned labor market risks, but there's concerns with the unusual nature of what's going on now with employment conditions. You have less supply of labor, so less available workers because of the immigration restrictiveness. And then you also have weaker demand for labor. But it's really unclear at this juncture whether it's less labor supply or less labor demand that's really moving the needle significantly. That was part of the decision, of course, to enact a risk management reduction of 25 basis points, just in case the labor market is weakening a lot faster than expected beneath the surface. The Fed has dual mandates of maintaining stable prices, which over the long run, the objective is 2% inflation and low unemployment, right? The idea is protect the currency, keep price increases subdued, while also keeping the population working at a high level, low unemployment, so that the economy can be productive and continue growing and that living standards can improve over time. Markets are loving it. The stocks are at new all-time highs, particularly the rate-sensitive areas that are more sensitive to monetary policy accommodation. Russell 2000, for example, up 2.5% today, really leading the pack. And stock investors are really happy that the Fed cut rates in September, but also pointed to one or two remaining cuts by the end of this year in their summary of economic projections, which they release quarterly at their June, September, January, and March meetings. December and March meetings. And they essentially pointed to one or two more cuts this year. But what's upsetting Treasury market participants is that the Fed only pointed to one cut, just one, in 2026, and just one additional one in 2027. Going into this meeting, the market was expecting 6 rate cuts by the end of 2026. 3 this year, which included yesterday's on September 17th, as well as 3 in 2026.
Oh, so less eggs in the Easter basket here.
Down the line, yes, but right now, from now to Christmas, things are looking pretty good. Also in the projections include estimates of unemployment growth and inflation. Growth got revised upward. Growth has been doing a lot better recently, especially in the second half of this year. We've seen consumer spending really rebound. Also this week, we got a really strong retail sales report. It was the third consecutive month of strength coming off of a first half of the year, Mary, where things were very turbulent. No one really knew what was going to happen. Tariffs were very elevated. The perception, rather, that tariffs were going to be very elevated drove that April sell-off in stocks and treasuries. Interest rates shot up. Stocks went to the basement. President Trump came out with a board with numbers next to each country, very high numbers, 40%, 30%, 50%, et cetera. In reality, the average tariff rate is only 15%. So it's not, in my opinion, enough to make a real meaningful impact on inflation or on growth in the long run.
What about this? Isn't there some sort of legal thing coming up about these tariffs and whether or not they're official or legal, and some may be rescinded and we may have to pay back? You hear that in the news too. And then the other question I wanted to ask about is that President Trump was in the UK yesterday, right? It seemed like very upbeat. There were going to be some deals with the UK. What do you know about that? Anything? I'm sure you do.
Yeah, no, we were really busy covering the Fed decision, but there seems to be an ambiance that the UK and the US is getting closer. There's a lot of talks about what's happening with geopolitics. President Trump thought he was going to get his way with President Putin of Moscow very quickly, and it looks like that's really looking like a more longer run kind of battle. We also got news from India this week that India's been caught in between the superpowers. Really, geographically, they're closer to Russia and China. They've been buying Russian crude oil for a long time. That makes President Trump angry because he doesn't want the Indians to be essentially subsidizing the Russian war machine. But the Indians argue that they need to buy energy and it's better for them if they can buy at a lower cost. So these are some of the topics that are occurring on the geopolitical stage. Of course, the UK has a really sweet trade deal with the US, only have tariffs of 10%, whereas with the EU, tariffs are higher, as well as with the UK, the tariffs are below average. The UK is essentially on the president's more positive list or perception. And then also the royalty. President Trump likes it when Prime Minister Starmer comes in and gives him a letter from the king, and he was with the king yesterday. And it seems like things in the UK are going well between UK and US relations. The UK, however, Bank of England did not cut. Their inflation is up at 3.8%, even though their job market is weakening significantly. Inflationary pressures are too strong in England right now for their central bank, the BOE, to continue cutting. So they remain steady this morning, September 18th.
So just to wrap up a few questions, let's bring it back and ground this conversation with some facts about this whole Fed thing. First of all, how often do the Fed governors meet?
8 times a year.
8 times a year. How many governors are there? If they do want to announce 2 more rate cuts, can they just spring it on at any time? Or does it have to be an official meeting and everybody votes? Or how are they going to do that if there's only 1 meeting left, maybe 2 more rate cuts? Do they double, like a double scoop of ice cream? We're going to give you 2 rate cuts for 1. Like, how does that work? Or they just announce it, or do they have to vote on it?
So that's old school emergency meetings. If there was something crazy happening in the economy, they'd hold an emergency meeting and cut rates right there. But these days, we're not really in right now at this juncture. Economic conditions are quite buoyant. So unless there's a accident in financial markets or something, or in the economy, not really expecting emergency meetings. We do have in October and the December remaining. We had 6 this year.
Okay.
So we have 2. Yeah, so we have 2. As far as what markets are expecting, they're expecting either 1 or 2 more cuts. That's what the Fed was expecting going into yesterday's meeting. Folks were expecting 3, essentially 2 after yesterday's. Now it's between 1 and 2. That was a long question.
I
What else
think
did I
we're
talk?
good.
Oh, governors.
Yes.
There's 7 governors.
There's 7.
There's 7 governors.
Okay.
They vote at every meeting, all 8 meetings.
And they're there for how long? They're 12 years? Is it?
14 years.
Oh, wow.
But there's 12 voting members because there's 5 regional bank presidents that are voting. One is always the New York Fed president voting. And then the other 4, they rotate every year.
And so we got to keep our eyes peeled, and we'll keep listening for all the economists out there, especially you, to see if you hear any news. And once again, Jose Torres, thank you so much for joining us. And we'll be doing this weekly, folks. It's all about economics and trying to understand the various reports that are coming out or just market action. Seems very topical at the moment.
Next time, we got to talk a little more about forecast contracts. September 17th on Fed Day, we had year-to-date record north of 1.1 million forecast contracts being traded yesterday on Fed Day. It was driven by Fed funds contracts. People were going nuts trading before the report. So it was really buoyant, a lot of activity. We invite all of you to come into our forecast trader markets. It's simple, powerful, lots of choices as to what you want to invest in. Really 5 major types of participants. We have investors, we have hedgers, we have speculators, we have arbitrageurs, and we have market makers, as well as folks from all walks of life. We'll be integrating forecast contracts also in the Sense of Security weekly podcast, which we'll be doing.
All right, Jose, thank you. And I know
Thank
you're
you,
busy.
Mary.
We appreciate your time. All right.
Looking forward to next time.
Yes, thank you. Thanks, folks.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Displayed outcome information is based on current market sentiment from ForecastEx LLC, an affiliate of IB LLC. Current market sentiment for contracts may be viewed at ForecastEx at forecasttrader.interactivebrokers.com/en/home.php. Note: real-time market sentiment updates are only active during exchange open trading hours. Updates to current market sentiment for overnight activity will be reflected at the open on the next trading day. This information is not intended by IBKR as an opinion or likelihood of a potential outcome. Interactive Brokers LLC is a CFTC-registered futures commission merchant and a clearing member and affiliate of ForecastEx LLC. ForecastEx is a CFTC-registered designated contract market and derivatives clearing organization. Interactive Brokers LLC provides access to ForecastEx forecast contracts for eligible customers. Interactive Brokers LLC does not make recommendations with respect to any products available on its platform, including those offered by ForecastEx. Forecast contracts are only available to eligible clients of Interactive Brokers LLC, Interactive Brokers Hong Kong Limited, and Interactive Brokers Singapore Pte. Ltd. Futures, event contracts, and forecast contracts are not suitable for all investors. Before trading these products, please read the CFTC Risk Disclosure. For a copy, visit our Warnings and Disclosures page.
This is commentary on economic, political, and/or market conditions within the meaning of CFTC Regulation 1.71 and is not meant to provide sufficient information upon which to base a decision to enter into a derivatives transaction.